Imagine I handed you a blank sheet of paper and exactly $10,000. No string attached except one. You have to manage it, you have to make it grow. What's the first thing you do? If you're like most people, you start looking for the winners. You start looking for the stocks that are going to double, the crypto that's going to the moon, the magnificent 7 tech giants that seems invincible. You want that feeling of safety, the idea that you're going to pick the right name, you'll finally have the peace of mind. But here's the question that stops most people cold. How much are you actually allowed to lose before you lose your mind? Most people think portfolio management is a picking problem. They think it's being a psychic. But the professional, the hedge fund managers, the big banks, they know a secret that changes everything. Portfolio management isn't about picking. It's a sizing problem. And if you don't understand the difference, you aren't investing. You're standing on a bridge that is about to start swaying. Let's start our story with $10,000. You feel confident. You pick Microsoft, you pick Nvidia, maybe a little Apple. You feel like a genius because you're diversified. But then you look closer. You realize that your special picks are exactly the ones that everyone is holding. You realize that if you just bought the S&P 500, you would own exactly the same things. So you take the smart route, you sell the individual stocks, and you buy the index, the S&P 500, the QQQ. You've been told this is the safe way. You set it, you forget it, and you wait for your 8% return. For a while, it's beautiful. The sun is shining, the magnificent 7 are carrying the entire market on their back. You feel like you found the free lunch. But what you don't see is the crowd. You don't see that you are part of a synchronized flock of birds, are flying into the same direction, watching only the person right next to you. Suddenly, the sentiment shifts. Maybe the Fed announces a rate cut that's smaller than expected. Maybe the super agent, those massive forces like the government and the hedge funds, they changes the rule of the game. Suddenly, your safe ETF starts to drop 5%, 10%, 20%. Everything starts falling at the same time. You thought you were diversified, but in a crisis, correlation goes to 1. The magnificent 7 aren't protecting you anymore. They're the one leading the charge off the cliff because everyone is trying to exit the same narrow door at the same time. When the market panics, you aren't an individual investor anymore. You are a reactive agent in a feedback loop. And the more you try to fix your portfolio by panic selling, the more you're contributing to the very crash that's killing you. While the retail world is screaming at their screen, someone else is sitting in an office at an endorsement fund completely calm. Why? Is it because they have better data? No. Is it because they knew the crash was coming? Probably not. They're calm because they solved the sizing problem before the first dollar was ever invested. A professional like a manager at a university endorsement doesn't invest $10,000 because they like a stock. They invest on a loss tolerance. They look at the $10,000 and say, I cannot afford to lose 5% of this without affecting my ability to pay the bills. They don't use volatility as their measure of risk. Volatility is just a range of uncertainty. If you're long a call option, you actually want volatility. You want the market to go wild. Instead, they focus on the gain-loss ratio. They ask, what is my expected gain versus my expected loss? They use the Kelly criteria to decide exactly how much to bet so that even a worst-case scenario is just a line on a spreadsheet, not a life-altering disaster. They size their position so that the volatility doesn't affect their daily life. They have built a perpetual portfolio, one designed to last for hundreds of years, not just until the next Fed meeting. Let's talk about the free lunch again. Diversification. You've been told that buying different things is enough. It isn't. To actually eat the free lunch, you have to rebalance. Think about 2 assets that moves in opposite direction. Asset A doubles in first year and asset B halves. If you do nothing, asset A now dominates your portfolio. In year 2, when asset A eventually crashes, and it will, you lose everything you've gained. But if you rebalance, if you have the discipline to sell a piece of the winner and buy more of the loser, you capture a compounded return that stays with you. The professional's edge isn't picking better. It's the mechanical, boring discipline of rebalancing. They realize that the market is governed by power laws. They know that 80% of the gain will come from 20% of the asset. But they also know that you can't predict which 20% it will be. So they don't try to be psychics. They try to be survivors. This brings us to the end of our story. Most people start with the dream of making 50% or 100% return. They want that alpha. But they forget that their risk isn't the market. It's their own psychological risk. If you lose 50% of your money, you might stop investing altogether. You might lose the tuition money you saved. The professional managers at Harvard or MIT isn't looking for a home run. They're looking for a consistent 8 to 10% for spending, 3% for inflation. They know that if they can just stay in the game for 100 years, the math of compounding will do the heavy lifting for them. They use stop losses, not because they're afraid, but to create asymmetric payouts. They cut their losses early and let their winners run. They don't let their losers grow until they dominate the portfolio. We started with a blank sheet of paper and $10,000. Two people can take that same sheet of paper and buy the exact same assets. The first person put all the $10,000 in S&P 500. When the market drops 20%, they panic. They sell at the bottom, they lose $2,000, and now more importantly, they lose their confidence. They stop. The second person look at the same S&P 500, but they only put in what their loss tolerance allows. They keep some in cash. With current Fed rates, it's finally a viable place to park capital. They might even have some bonds or private equity. When the market drops 20%, they don't panic. They rebalance. They sell a little cash and buy more of the index while it's cheap. Same assets, completely different outcomes. The first person was trying to predict the market. The second person was trying to survive it. Winning in this game isn't about having a crystal ball. It isn't about being the smartest person in the room or beating the super agents like the Fed. Winning is about sizing. It's about building a portfolio that allows you to remain calm when the crowd is screaming. It's about knowing that volatility isn't a disaster. It's just the price of admission for the only free lunch in the world. So take that blank sheet of paper. Don't write down the stocks you love. Write down how much you can afford to lose. Start there, because the real edge isn't picking the best stock. It's building a portfolio you can actually survive when the world goes crazy.